Joining me is Michael Cuggino. He's president and portfolio manager of the Permanent Portfolio family of funds. Michael, good to see you again. I mean, is stagflation more or less the investment thesis that you're making here as well?
Yeah, good afternoon, Kelly. I think your previous guest nailed it. It's kind of one of those situations where we're somewhere in the middle. Yes, there's growth, but it's slowing. You've got geopolitical risks. I would agree on a diplomatic solution, but I think the devil will be in the details. The Ukraine has done a lot to put themselves in a really good negotiating position, and it appears they may continue to do that. They should be careful what they settle for if they truly want independence. But, you know, that will definitely impact global growth, the globalization of economic activity. Those are all negatives. Corporate profits they were, still beating for the most part last quarter, but not as much. The comps are getting harder. Cost of capital is going up with rising interest rates. There's a question as to how much that can happen before it turns into a negative. Inflation is high. Stagflation is a risk. We can go on. And unfortunately, we don't really have answers to a lot of these questions right now. So it argues for a diversified, driving down the middle approach to from an investment standpoint.
You may not have answers, but you do have strategies. Say you're looking for companies that can control their cost structure, have pricing power, and reasonable or likely growing dividends. Give me some examples. Materials, commodities. I see some financial plays in here.
Yeah, we would definitely look at those industries as industries that can control their costs and have pricing power. And so that's, again, on the equity side, that's where we're focused on, things that will weather the storm or weather an inflation risk. Also, I would say some growth companies, growth at reasonable price type situations, maybe in tech, maybe in some other areas, that would also help. But it goes beyond equities. Bonds were short duration, high quality balance sheets so that we maintain a lot of flexibility if rates go up and if market rates decouple from what the Fed wants to have happen. And in an inflationary environment, the opportunity cost, obviously, when rates go up, people sell gold and other precious metals. But the reality is that those assets hold value and you want to own them for the same reasons that interest rates are going up. So we would advocate having an allocation to that as well. Real estate is another asset that holds value in an environment like this. So it's a diversified approach that goes well beyond just equities. But those are some areas that on the equity side would be names we would be looking at. Chevron, Oxy.
Yep, Chevron, Oxy, sorry, absolutely. Freeport-McMoRan I see here as well. Do you expect the market overall to be higher at the end of the year?
I really don't know. We don't make predictions. I think there's a lot of risk in a lot of different areas. And while we can say that really at any moment, I don't think, 5 or 6 years ago, there was a one-directional market. You bought your cheapest equity ETF and rode that trend. Low cost of capital, benign Fed, benign geopolitical situation, no inflation. That has changed, and I think that's going to change for the next several years, if not longer. And investors have to take that into consideration with respect to their risk-return profile, their expectations, their capital needs, et cetera. And you got to remember, too, with inflation right now, your holding cash is a negative 8%. We don't know if it's going to stay there, but it's still negative. So you want to be doing something to mitigate that impact on inflation and offset it as much as you can.
Yeah. Well put.
Diversified approach we think would help that.
Michael, thank you for joining us today. It's good to see you again.